What? Oh, we're straight to live.
What's up, guys?
Hold on.
Hey.
Let me see.
Good afternoon. Happy, wonderful Wednesday, everyone. We're here for another episode of Ask Me Anything. And we have people coming in. So we're going to be like the Brady Bunch. We're going to be in and out. We're going to answer questions. We're here to serve. We're here to help you. And we're excited to be here today. So we're going to go around the room. We got Dr. Shauna. So
I don't know where that came from.
Well, you know, Stephen Nagy with all of his insanity last time was just naming us all. So
yeah, they must automatically come up on here every time.
Tell us a little bit about yourself, your week. How are things going?
Going pretty good, actually. I think it's been a really great week. I feel like we were really productive. I'm definitely riding like a high of efficiency right now, so I'm happy to be here.
You at home?
I am. I'm in the living room. We're kind of running. Yeah.
You painted that yourself, right?
Yes. Yep. I did. I painted the wall.
Yeah, and now she's got like a magical dinosaur or something on the wall too. I don't remember seeing that before.
I've had it. Have you ever seen Pee-wee's Big Adventure?
Oh, yeah. That's a great show.
You know when he goes like to the, I don't know where that is, in Palm Springs or something like that.
I was gonna say it's California. It's out by Carson somewhere.
That's like my Pee Wee Herman. I don't know.
Tribute?
Yeah, kind of.
Awesome. Do you have the Pee Wee Herman bike?
No, but I have a red car, so it's like kind of that.
That's amazing. And we got the married man, America's youngest money mentor, not the newest on the team, but the youngest. So Carson, what's going on? Tell us about yourself. How you doing?
Nothing much, man. This week's been pretty good. I'm not going to be here for the next couple of weeks. So as you guys know, I don't know if you actually all know this, but I served a church mission. I was gone for the year of 2021, and I was living in the country of Georgia. And I am now married, and I want to take my wife to go see where I lived. So next week, we're going to Georgia for 2 weeks. Pretty excited about it. So I'll be gone for a little bit before I come back and join you guys on this again.
That's incredible. How many 21-year-olds do you know that are out there serving, giving contribution at a young age, and then sharing it with others, man? That's incredible. Thank you for your heart and giving. I know we don't talk about it much, my wife and I, but one of the reasons I got her on board this crazy train was like, listen, honey, we can either accumulate and wait for one day someday, which maybe will never happen, right? And we'll be in our 60s, or we can start taking back control of our life now and start giving more now, because the more we scale, the more we can give.
Yeah.
And we have an orphanage in Malawi that her uncle supports and has built a lot of it. And so for the last several years, we've been able to give to them a little bit at a time and, you know, build them bathrooms and buy them clothes. And just, it's super rewarding, Carson. So I can't even imagine. Awesome. We can't wait to go there and meet them. All we're doing is giving.
Yeah.
But just to be able to do that, right, is amazing. And then we got, last but definitely not least, we got the Yeti, the Craig Yeni. So how's it going there, Mr. Yeti?
Doing well. And that's more like Yeni, like Yanni, but with an E.
It's way more fun to call you a Yeti. You know.
Yeah, so I was just sitting here reading this book. Have you guys ever heard of this book? I was just sitting here reading it. This thing is really cool. I'm really blown away by all the cool stuff in this book. I don't know if you guys have read it, but I'd recommend it. So I've been talking a lot about stealing the peas. A lot of people have been, asking about how to pay down debts. And of course, we can do that more efficiently with the infinite banking concept, but we don't want to steal the peas and just pay those debts off and not put the money back into our own system. So it's been a busy week talking about debts.
I love that. And why do people want to steal the peas, man? It doesn't seem very cool. Like, who even wants to eat peas anyhow? But then why do you want to steal them?
Well, peas are good. I do like peas, but yeah, I wouldn't want to steal them.
That's awesome. And I'm Jason Sipple. I'm down here in the city, beautiful Orlando, which can't decide if it's going to be hot or cold. Like, we start out at 47, then we're in the mid 80s by the time I walk out. So starting a sweatshirt, walk out. I know really big, tough problems because everyone I'm talking to is still getting rain, snow, and everything else all around the country. A lot of worries about flooding and different things. But we're here for another Wednesday edition of Ask Me Anything to answer all your questions and have some fun with y'all. Anybody have an
I have I just want to say I am here. I'm in the background.
God, is that you?
I was finishing up a call, and then my husband kind of took over our office space, so I had to move to the bedroom. So you're all you can't. You're not allowed to see that. But
Yeah.
so I'm on.
We
I'm
got
just
a little
on
bit more
audio.
racy in here.
Just want to let you know in case I
PG
decide
show.
to pop in, not scare the living
You did.
crap out of you.
You did.
I thought I had all the toys hidden in the new area, but that is look at that. That is the right.
Looks like my house. I don't feel so bad.
Connor is very upset that I've taken over the loft, and this is going to be our new office / studio and playroom all at the same time. So we got Millennium Falcons behind us.
I was going to say that.
See that? So all kinds of fun Star Wars stuff here. But Gabby, please, from behind the scenes, please lead us.
Yeah, so there is one pre-submitted question we can get into from Haley. She says, what insurance companies will let you structure the policy? Who wants to take that one?
Don't everybody jump in.
What do they mean, structure the policy?
I'm assuming get an IBC policy, structure it like IBC, like we teach.
Well, we work with One America, Lafayette Life, and then if you're in the New York area,
right away.
Yeah, I mean, I don't hide it. I mean that they're great companies. That's
straight to the point. We're not used to that.
Two most common. Well, let's see. One of them has a number in it, and it has a country name, and then so.
Yeah.
But that's not all of it though. Too, you do have to connect with someone on our team. If you were to just call like 1-800, what is it, Guardian or 1-800 Mass Mutual, they're not going to do what it is that we do. So I actually, you know what, guys, that reminds me, it was a couple Ask Me Anythings ago when we were talking about your policy, Craig, and I said, I think I made like a call out, like just being like, does anybody just have, a regular whole life that they've had for a really long time? And I think it was Derek emailed me. I just want to check if I have it.
Yeah, in mine, I wouldn't say mine was a regular. I mean, it's definitely structured for IBC. It had a little bit higher cash value than I probably needed at the time, but there's a Lafayette Life. So what is who that was with?
Well, I feel bad because I have so many emails since like the last 2 weeks, so I can't find the exact one. But he was kind of mentioning, he had a whole life insurance policy for quite some time. And when he called his agent, who I think he's had it for 20 years, was like the same like local agent that his car insurance or homeowner's insurance might be through too. And when he mentioned, he was interested in using it, she told him that that's what she does. But when he bought the policy, she didn't tell him that that's what she does. You know what I mean? Like she just sold him whole life because that's what he came in and asked for. So
and she makes more money that way.
Yeah. So, I mean, I'm sure he's sitting on cash value that he can tap into and all is well and fine. But if you call up 1-800 Mass Mutual, which is a whole life, insurance company, they're going to give you a whole life insurance policy. They're not going to give you an infinite banking policy. So you want to tap into people who can do that.
Yeah. They don't have an infinite banking department.
Yeah.
Yeah. And you have to be careful. You have to be careful too, because a lot of people say they know how to set that up. And in my own experience, when I started this, first thing I did is I called my insurance guy that does my home and my cars, and I asked him about it. He goes, oh yeah, I can set that up. And so I had him run a policy for me, and then I compared it with the guy that was working with me. Like, these are completely different animals. So you also have to be careful, because there's a lot of people out there saying, oh yeah, we can set that up for you. But
yep.
A lot of people are saying,
yeah, it was Derek. I have the email right here. It's what he said, I called my agent to ask about it. Currently, the cash value is earning 3%. I've had the policy since 2001, so 22 years at this point. I played dumb and told her I was just learning about my insurance policy to grow my money, and she told me, yes, it's my bank, implying that she uses her money to move money. And he said, I thought it was really funny and eye-opening. Wonder how many agents really know how to create a decent policy and deny it. So that was really interesting. Derek, thank you for being here a couple weeks ago and, that feedback and confirming that for us.
And Shauna, thank you for taking it back and acknowledging Derek and bringing that in. And I would say, Craig jumped right in and gave the names, right? It was really fun about it. But at the same time, when people ask me that question, we'll always give all the information, right? We're as transparent can be, but that's not always in service of someone. Because really at the end of the day, it's like, what is your thing that you're solving for? what is the opportunity that's in front of you? Like, are you recycling, recapturing debt to grow your wealth through your debt? Or, do you have lazy money sitting around in a money market or a savings account that you want to put to work and protect? Are you buying all your like, what is the thing, right? And once we know that, we all as money mentors have the conversation and listen for all of the indicators. Like, do you live in New York? Well, that kind of limits what we can do, right? Do you, are you someone who has a certain amount in mind that you have in disposable income a month, right, in surplus that you want to put into it, but you have this windfall that you want to dump in? And now what are the pros and cons of that? And then where do we need to take you? Right. So the thing I always start with is hey, they're all A+ rated mutual fund, dividend paying, whole life companies that haven't missed a dividend in over 100 years. And that's all super important. It's a lot of words. I don't like saying it, but it really is saying this is what you're going to own is a piece of this. Right. And then going through the companies if we need to, right? Whether it's Lafayette or One America or Penn Mutual, and are they direct or indirect? And then all the layers that we peel back during that. So.
Yeah, good point, Jason. So Haley, hopefully that helped kind of clarify some things there. This one. Let's see. You said how to pronounce your name, and then I lost it. Oh, Yunhee. Yunhee says, "Where's Chris and Steven?" They're in California, San Diego. They have an event out there. Secret knock.
Yeah, you're only able to get in if you know the knock.
Yeah.
I don't think that's it.
But if he's going surfing, if anybody's out in San Diego, he's looking for people to surf with on Friday. So,
Dexter's out over there.
Oh yeah.
Yeah, probably. He was supposed to go surfing with Jay
Who's
Hobson
surfing?
too.
Steven or Chris or who's surfing?
Chris.
I would
Steven's going
Steven.
home.
I think it would be funny to watch Steven surf. I don't know. I don't know how he would do. No offense, Steven. Just curious.
Love you, Steven.
So next video.
Okay. James, I think is how you say that.
Did we answer the was it Yunhee's question yet?
Yunhee. Yeah, where's Chris and Steven? That's what we just covered.
Oh, that was the question, because there's a couple other ones. She's got a testing, or he.
Yeah, those are down a little bit farther.
Okay, gotcha.
James says, "Hello, can you explain the mechanism or timing to transfer or pay back the loans to the insurance policy from the segregated money account? How often can you make payments?"
Ooh, this is a question with so many answers. Who wants to take it? I mean, this we can go in so many directions.
Jason, you take it.
I will start it, but I want to look. Craig already has stuff to say. So does Carson. He leaned in like he couldn't get any closer to the screen, and so does Sean. We all want to talk about it. But I would just ask, if we were thinking about things, would we agree that the wealthy have more options than the majority of us? Do the wealthy have more options? Right. Yes. And this is one of the first things, like when we think about the kind of loan repayments and what we're doing, they're typically a structured loan, meaning that you're going to know what's the duration. If it's a mortgage, 30 years, what is the percentage, right? What are you paying on that? What is a monthly payment and when's it due? Right. That's structured. Well, when you're wealthy, even though we don't want to steal the peas, we have more options to pay it back. So we can pay that back in a number of ways. It depends on what the goal is, what the investment's for, we're taking the money out for. Are we recapturing? Are we going to pay that back to ourselves? Are we doing an investment that's going to mature later? There's just a lot of options. And if you ask Chris this question, he's going to give you one answer, how he sets up his loan repayments. If you ask Brent Kessler, and he's like the Wild West, he's going to do something completely different. But they're both super successful. So it's also, how do you cash flow? How do you think about money? How does money work in your world and flow? So those are just some of the things to kind of think about. So who else wants to add? I see Craig.
Yeah, I mean, from my perspective, I'd go to the same place you went, Jason, with just, it's use case driven, right? Yeah. So from my perspective, if I'm looking at a debt pay down, I'm going to structure that differently than if I'm doing an investment strategy. So for example, if I'm doing, an investment strategy, private money club, taking money out of my policy, if I don't need the money that investment's generating, I'll just stick it back in the policy, do the loan payments. But eventually, when I get to the point where I just want that cash to live on, I'll pay the loan interest at a minimum, but I won't pay the principal back. So all of these things, to Jason's point, you have options. But if we're paying down debts, then I would structure that to where you can pay down, those third-party debts and then recapture that into your own policy. Mm-hmm. The mechanisms as far as when and how you pay those are up to you. Loans can be paid back throughout the year. And when you do that, that goes 100% of that goes to principal, simple interest loan. So the cool thing about that is if, let's say the interest rate's 5% and you're paying principal back into that loan throughout the year, it could turn out to be a 3% interest rate because you bought that principal down, which makes that interest charge lower. So principal gets paid throughout the year. One time a year on your policy anniversary, you can make the loan payment or the interest payment back. But again, all of those are going to be driven from the use case. Are we paying down debts? Are we making investments? Are we buying cars? What are we doing?
I also want to add, it kind of, you've probably already encountered options in your life where like I know someone mentioned that they want to move into an RV, and like I have an RV, and when I bought the RV, like I basically could choose how long I wanted it. So it's also like the preference of your particular taste. So I don't like being in debt very long. So I'm one of those people who I actually will eat a really big ass payment every month because I want to get that thing paid off. Or there's people who are like, I'm going to stretch this out, 10 years and have a low monthly payment. So it's kind of, I think even if you go car shopping, you have like the same option when you get that loan. You could do 60 months, 72 months. You could do, so it's also like it's also personal preference and how you've probably lived your life thus far, because habits kind of don't form overnight. So it's probably going to be a little bit what you've already kind of leaned towards. And then you maybe want to make better choices and better shifts from that point.
Yeah, I like that.
What are you thinking?
Yeah, I like that, Sean. I was going to say, Craig kind of hit on it for a second, but what I was going to say is if you have a need for that money to go somewhere, keep it moving. Keep it in the next investment, rolling over to something else, paying down the next thing. But if you don't have a need for it, it's in a little break period, you don't have enough to put it out to the next use, leave it in the policy, go put it back. Might as well. So all these points are kind of hitting on that. It's really personal preference, but it depends on the situation.
The use case scenario, I think Craig summed it up super simple. I'm going to tell a quick fun story that I get to share that I learned from my mentor, right? Who has 8 of these policies. He learned from Nelson Nash as well, right? He's a fiduciary. So he has a fun story where, does anyone like whiskey barrels, like whiskey here? It's happy hour, right? So he decided to take a $50,000 loan out against his policy, right? From the general account, right? Collateralized his money, took it out and put it into a fund to buy aged whiskey barrels at $1,200 a piece. Right. In 2 years, they're supposed to be able to sell them for $3,600. So in that 2-year period, he borrowed at 5%, right? It's a One America. So he's going to pay it back $2,500 a year at simple interest. So it's not eating the policy growth, right? In those 2 years. And then when that matures, he'll have $150,000. He'll find out how much he can stuff back in without it becoming a taxable event. And then what happens? Then he needs a warehouse to rest that $90,000. That's the trigger for the 9th policy. So you have options, right? If you have an investment like that, just you get to use. And people are like, well, I don't want to pay $2,500 a year, but your money's growing $50,000, earning you guaranteed interest, most likely dividends, right? If you're One America, 124 years and running, and you have your money potentially making you $100,000 in your right hand at the same time. So is that really and when you pay the dividends, it's your company, you're an owner in it. If they do well, then the dividends might increase. So it's an everyone thrives mentality, if you think of it that way. So that kind of little story I like to tell kind of breaks down multiple parts of what we do and the options you have. So.
Got a lot of questions right now.
Yeah, we do have a lot coming through. Edward's next. He says, will they count that 75% cash out refi as a second loan? And this is while doing the Burr method.
I think we're missing a beginning to that because I don't quite.
The only other thing I saw from him was that he had a question. So Edward, if you can kind of clarify
Somebody call Devin.
Yeah, Devin's the Quicken Loans guy. He would know.
All right, we will come back to that, Edward. Okay, we'll go to Matt. Matt says he's 43. He had a heart attack last year. Do you have any guidance when he may be insurable at a favorable rating, if ever? This is more of like an applications team specialty, unless somebody's had something similar. But I definitely think it's a case-by-case basis. It depends on a lot of other factors, the height to weight ratio, other medical history, any other complications from that. So they'll look at like the whole pie. It's not just like a one size fits all. But what we can do is, Matt, if you want to email one of us, actually I can put my email in the chat, and I'll just have you email me. And what I'll do is I'll work with our apps team and just see kind of based on your specific information, whatever you're willing to share. Obviously, if it's not a full comprehensive look or questioning about it, there may be more to it, but I can at least give you, we can at least give you a general guideline to look at. So let me put my email in the chat. If anyone else has anything else that they want to add to.
No, I think it covers it because it is dependent, and we'll have to get more information from probably someone on the application side because they deal with this more often than we do.
Yeah, and I can give a little guidance. Like it's going to be user case, right? But I had someone yesterday who asked the same question, and once you have some of these type of situations, right? What I did is just took his information. Because he started like, hey, I had open heart surgery, I had a valve replacement, I'm super healthy now, right? He had an aortic dissection, which only you have a 3% chance you're going to live. And so to have a clean bill of health multiple, like 10 years later, is incredible. It's a miracle, right? And then we went to underwriting, preliminary underwriting, and they came back, said, yeah, he might pass, but it'll be probably table rated. He won't be able to have this, and this if he passes. And so then it's really easy to go back. And if that's your only option, you can still create a banking policy, right? You might not be as efficient, but you can still do it. But if you have another insurable interest, that's when we got to rethink our thinking and start getting creative. Like, how can we help you by who's another insurable interest, business partner, family member, something like that? Like, does it make sense to use someone else's body to build that? So.
Yeah, good point, Jason. Yeah, that's a good question, Matt. So yeah, reach out to me and then we'll kind of see. Sometimes we're able to reach out to the insurance companies and just kind of get a preliminary, hey, would you consider this person? What would you need to be able to consider them? So they might be able to give us that information. Eve says, for the policies in the states that don't automatically get shielded from judgments, what's the form we would need to file to have our policy shielded from judgments and such? As far as I know, there's not a form. It would be more like a trust structure. Is that kind of what you guys know?
Yeah, every state's got different rules on what they protect from judgments. So I don't know if there's anything you can do about that outside of protecting it in some sort of a trust structure.
Yeah, that's a good question, Eve. But I don't think there's just like a form. I think if there was a form, we would have everyone fill it out. But yeah, I think if that's the case, if you're worried about that, then definitely just talk to somebody about a trust structure. It's not always the right fit for everybody, so we don't want to just hit by, hey, go get a trust.
Yeah, the other piece of this too is what is accessible in a judgment would be the cash value. So if you just keep it deployed and keep it out working, it's not there to take. So,
yeah.
If you have a policy that's just accumulating a bunch of cash, then, that's a little bit riskier. But if you can get that out deployed and working, then, it's not there to take.
That's a good point.
Great point.
Okay. Yun-hee says, since I am borrowing the insurance company's money and I pay them back, how is this increasing my policy's amounts accrual above what is already inside growing?
Yeah, I can hit this.
All right, Carson, get it.
I had a question similar to this when I first learned about it. And I was talking to Jonah Dew at an event in the Banking Bros. And I asked him this question. And he gave me this analogy, and I've been using it ever since. He says, there's two buckets in your life insurance policy. The first bucket is the premium the premium bucket. The second bucket is the cash value bucket. Two separate things. Your premium is what you can contribute every year, every month, whatever you end up doing. That's going in there every month, consistently staying there. You're always going to do that, and you'll earn interest and dividends on this amount. Your cash value bucket is something else. It is an amount the insurance company says you can take out as a loan. And yeah, that number is based on your premium, but nonetheless, it is different. When you take a loan from the insurance company, it's coming out of the cash value bucket, not the premium bucket. The premium was never touched. The cash value bucket was what you're moving money in and out of. So when you pay it back or take it out for a while, whatever you do, the interest will be charged in that bucket, but the premium bucket's never going to stop. And so that's typically how I would describe that.
I think that was great. And also basically you need to move the cash value bucket. Like, so that's the best way that you can increase your money is by utilizing it. So, I guess we always teach that too.
Yeah, there are two other pieces I would add to that. One, when you are using money, do you want to use money from a bank that you're not part of, or do you want to use money from a banking system that you're part of? So mutual-based company, you're part of that company. So in a roundabout way, through dividends, you're participating in the health and wealth of that company. So why wouldn't we want to use the insurance company's money versus some other third party? The other piece, we'll go back to, and I know, Drew, you like broccoli. You mentioned in the comments. So I'm going back to the peas. If the insurance company is charging 5.24%, and you are going to go buy a car at a dealership for 7%, we want to treat our bank just like we would anyone else's bank. So you'll end up overpaying that insurance company's loan, and you'll have more money that goes to your policy. That could be going back to your premium bucket that Carson was sharing. The problem you may run into is you can't get it all into the policy. That's a great problem to have. It can sit in a segregated account. But the things that help your policy grow are all these things we've talked about. Carson talked about the two different buckets, kind of increasing and decreasing. Using money from the insurance company helps the insurance company because you're contributing to the to their profits. And then also the policy, if you overpay it, like Nelson Nash, don't piece all that money back in the your premium side. That's how you're continuing to grow. Go ahead, Gabby.
Oh, sorry. No, I said I have just 3 words. I have uninterrupted compound interest. So uninterrupted compound interest, what does that mean? That's your ability to use your money and it can still grow at the same time. So saving and spending at the same time. If you think of the alternative to that, your bank account, your regular traditional bank account, do you have that power? Once you take a withdrawal out of your bank account, you can't, that's no longer compounding. It stops that compounding effect. So by borrowing the insurance company's money, now you can participate with the power of uninterrupted compound interest. So you never lose that power. You can use it and it can grow at the same time. So there's nothing else that gives you that ability to do that. And the banks don't use the banks. You can bet the banks are, not using the, traditional form of compound interest where, they're keeping their money moving, like Carson was talking about, so just think about it that way too. The cost of not being able to utilize the power of uninterrupted compounding interest is that you basically have a choice whether you use it or it grows. But with your policy, you don't have to choose.
And to that point, just to further that, so uninterrupted compound interest is one word, and lost opportunity cost is a close cousin to that. So here we have $1 million bill, and Jason, I want to buy those toys in your background. So I'm going to send you this $1 million bill. If I give
you got to negotiate with Connor, man. He's a tough negotiator.
Okay. So if I give this $1 million bill to Jason, what is my ability to earn any money or use that ever again? It's gone.
Gone forever.
But if I just take my $1 million bill and I put it in my policy and then I pay Jason, what Gabby just said, that uninterrupted compound interest, this thing's going to keep growing and growing and growing and growing. So I didn't lose the opportunity to use that money again. So that's the other aspect I think that I would add to this question.
And the question says above, right? So the above is what you were talking about, Craig, when you're you're paying something back at 7% and that 1 point, almost 8% spread. That is what's going to additional PUAs, and that's driving additional growth. And I think we gave a lot of great insights and information and went all the way around. But if we're looking at the above portion, that's how you make it grow faster. And then you'll just find out like how much can you put back in.
Well, question for you on that. I actually was looking into this. When you pay back the policy loan in full, you overpay it, any extra interest, maybe even more PUAs up to your MEC limit. Does everything you put in above it, does that also grow interest and dividends? All the extra PUA?
Well, yeah, the PUA is going to add your cash value. So all that continues to grow.
But can you earn interest and dividends on your PUAs, additional PUAs?
Sure. Yeah. So when you make those premium payments, that part of it's base, part of it's PUA, that all gets, when you look at the illustrations, they always have the PUA due to cash value, PUAs due to death benefit. So all of that, just makes the bucket even bigger.
Yeah.
Yeah. I mean, the answer is yes, because you think about it, like they're growing every day.
Yeah.
Right. Like they're literally growing. So it's that 3.25% with One America is accumulated over the course of a year. So if you put back above and beyond the loan, it just increases the math. You're just pouring more lighter fluid into it.
Yeah.
Right. And you're just doing that up into the limit to container size. And, to quote Brent, at some point you're trying to pour 16 ounces into a 12-ounce bottle and it just doesn't work. I mean, that's the trigger for the next, the next bottle, the next warehouse. So.
Yeah. So that actually answered. He has a couple additional follow-up questions. This is one of them. So Jason, that kind of answered this one. He says, "Are you saying that I can add funds into the PUA for the life of the policy?" So the answer is no, not for that particular policy, but you can start more and create that banking system with other policies as well.
Well, you can add PUAs to the policy longer than what we typically do, but that's just a matter of keeping that PUA rider, cost of like $120 a month paid. And then I like to do that personally, just because if I have some money I don't know what to do with, I can always throw it into a policy somewhere if I have that door still open.
Yeah, but just as long as you're not meching it.
Yeah, if you're not meching it. Yeah.
Absolutely. Yeah, and so I think we answered this too. Another follow-up question from Yoonhee is, does that mean it reduces the compounding interest in the cash value bucket by the amount of the outstanding loan? So we already said no to that. You still get that uninterrupted effect. And don't I accrue uninterrupted compound interest on both the buckets, premium bucket and cash value bucket?
Two different things.
Let's see.
Complicated. Craig's thinking. I can see the wheels going.
Well, I'm just trying to, if you look at, what Carson said with the 3 cups. So Jonah, he has the 3 cups. He does that all the time. And, the premium bucket and the cash value and the death benefit. But the premium bucket is the thing that just keeps getting filled up. The cash value bucket, to me, the way I look at it is it's an indication of how much I have available to use at any one time. Because some people, when they take a loan, they go, "Oh, my cash value decreases. Does that mean I lost some money?" No, it's just an indication of what's available. And when you put money back in the loan, it goes back up. So when you're using the money, your cash value is going to be going like this through life, but your premium bucket goes like this.
Yep.
So, and I don't know if you like those sound effects, but those are.
They definitely, now I'll be able to remember that information, revert back to the sound effects. Okay. Yoonhee's got a lot of good questions today. Okay.
Wow.
All of the companies you work with are indirect, correct?
No, they're not. We have 2 that are direct, right? We work with Guardian, who's direct, and we work with the other one is Penn Mutual, who's direct. Like if you don't like needles, Penn Mutual might be the company for you. There's reasons. Again, we work with all these different companies because of the different problems we're solving. And with all the great questions we're getting, I would still bring us all back to the process. We are teaching you the process of banking. Like banks are making 400 to 1,300% on your money. Go look it up, right? How can you start mimicking what they're doing? And, money doesn't have to sleep. Joe on our team has one thing on his wall. It says money doesn't, right? Money doesn't sleep. And it's just a great I think about it sometimes when I'm riding. I'm like, oh, Joe, with that one sign, money doesn't sleep, but I have to, right?
Yeah.
So,
Who would you rather want building your brick house? Would it be a god who never needs sleep or rest or food, or would you want to do it? Okay, let me get this out of here. Okay, so this one I read before, and it says it's from Rosewood. So when it comes to paying back a policy loan, how much control do I have in regards to paying it back?
As much as you want.
Who's playing whack-a-mole right now?
Yeah, we play like hands over that. Yeah.
Shauna, do you want to go?
Yeah. So we kind of hit on it a little bit earlier. How much control do you have in regards to paying back? You have 100% of control in regards to paying it back. And it's going to come back down to like your personal preference, right? Like if you take out a loan and it's like any other loan, you want to be making sure that you're using it for a purpose and that you would be making those payments back. So it's also kind of preference. I think earlier we talked about if you want to like replay or watch this, but we talked about, if you're using a car or house, like there's different lengths of things. Like some of the things that I do, I want to have that paid off in 12 months. So I split my payments into 12. It might be something small. Like maybe you're buying, I've heard Jonah or Jeremiah do that, I have to buy a washing machine. And it's like, you can go to Lowe's and buy one on your Lowe's credit card, pay that off. And maybe you want to pay it off in 3 months. You know what I mean? You want to make 3 easy payments to pay back that loan. So it just kind of depends on what it is and your preference.
You have options because now you're wealthy. You're playing the game the wealthy are. So you just have to learn how to play the game. And that's why you're here. You're asking great questions.
Okay.
And it does feel like whack-a-mole. I'm just going to say it. Like I started writing down my best answers, putting them in text messages so I could send them off. So.
Okay, Morgan says, we want to convert our current residence to be a rental property. I would like to sell the property to one of my LLCs. My LLC would need to borrow the money to purchase it and do a little rehab. Let's see. Does the team have any advice on how to accomplish this? We plan to move into our RV and live in it full time for at least a year, maybe more. So I'll put this up again so you guys can see the actual question.
I would say maybe bring this back. Maybe Chris might have some insight. Because I do know originally when he kind of got into flipping houses a little bit inadvertently too, like being like him and Larissa would buy a house in 2 years, they'd fix it up, and 2 years later they would move out of that house, essentially flipping it that way, like, as their primary residence. I don't know how that all works. Like it would, to me, I would want to know how to avoid closing costs and stuff on the house that I already have, like in having to deal with all that. So I don't know the answer to that. I don't know if anybody else today does have the answer to that. I know, Carson, you do a little bit of real estate, but I don't know about sort of selling it to yourself or how to convert that.
That's a good Devin question too.
Okay.
Yeah, that's a good question. My first question is, the LLC, you said LLC would need to borrow the money to purchase it and do a little rehab. So where is that money coming from? Is that something that your business already has, has an assets they're going to be borrowing from, or is it something that they would be needing a loan for? Could they get a loan from you, your policy, to do that? There's a lot of questions around that one. So,
I wonder if, how like there's, Pace Morby always talks about subject to, and it's kind of like taking over a mortgage. So I wonder if somehow your LLC can subject to, like, take over the existing mortgage and stuff like that, where maybe that is how you get around all the closing costs and all that weird stuff that a traditional bank is going to try to make you do. So look into, I would say, Google subject to and how that would work.
And I think too, there's going to be other variables like in the conversation that we can bring back, and maybe when Chris is here, see what he thinks. That it's what do you gross per year, or what's your net worth, like what's your age? There's all these other variables. Because at the end of the day, it still is life insurance. Like we can get as creative as we want. Like you can look at the Burr method, how Devin does it, right? Where he's going to borrow other people's money to buy something, then he's going to use his money to fix it up, and then he's going to pay himself back through the LLC, right? So there's just different ways that you can utilize this as optimal efficiency, but there's also variables I feel like we're not privy to in the question.
Yeah, and I wasn't sure if when he says borrow the money to purchase to do the rehab, if that's borrowing from a life insurance policy, borrowing from what? Mm-hmm. So a lot of times what you can do on the personal side is borrow the money out of the policy and then create a note with the LLC that, the LLC would pay you a higher interest rate, pay you back personally, you restore the policy. So there's a few different flows, but I think one of the things Chris always says is you would need to talk to your CPA about how to wire that all up and get all the, promissory notes and documents in place if you're doing something from the personal to the business side. But
and also what happens after? I know you said you plan to move into your RV and live in it full time for at least a year, but what is the plan for after that? Like, are you going to be buying another house or renting? Is the possibility of that residence that you're converting into a rental property to convert it into a duplex, and you live in, half of it and rent out the other half? And that's it just depends on the strategy and what the overall goal is for the entire thing, and beyond just converting it to a rental property. I know your location might factor in. There's a lot of different things that work into this too. So so I mean, that's definitely a more intense question, but a good question, Morgan. It's a really good question. That's how you should be thinking to figure out the best way to do that.
I also threw Devin's TikTok in the comments too, for anybody who wants to kind of learn a little bit about what Mr. Burr knows.
I'll hit on this a little bit. I won't spend too much time on it. He's asking about all of us being employed by TMM and how he can do it too. So we're actually in the process of developing a program to kind of educate people on how to do this. So just kind of keep your eyes out for more details on that coming out. It will be a paid program that anybody who's interested will want to be a part of. But there's more details that are going to be released on that. So just kind of stick around, and when that's released, anybody on here, I'm sure, will be the first to know.
Do you have a time frame for that?
I don't. I actually saw, I think it must be happening pretty soon, unless, Shawnee, you have a better idea. But I think that I saw the information sheet in the office the other day. I think it's at least the information side of it is coming together. And then they're going to be building the education pieces around it. So, but I don't have an estimated date for that. But it is definitely well underway in the works.
Awesome.
Okay. David and Dorothy. Hi. For our current One America policies, can we revise them to minimize the death benefit and max out on what we can take out? Who wants that one?
A lot of head twisting here.
Yeah, I honestly don't know. I would like to. I kind of feel like no, but I don't know.
I believe the direct answer. I mean, maybe Craig knows something I don't know, but I believe the answer is no. Like they're designed, and once they're in force, they're put in force to solve a certain problem at that time. So like now, if you have a new thing you're solving for, it's going to be creating something new to solve for it, or using this in a way that's going to solve for it versus trying to rearrange something that's already contractually done. Is that right, Craig, or is there more?
Yeah, I mean, I'm looking at, I don't know if I fully understand the question, but there are riders you can drop. So if you had a term rider, you could drop that. That's going to lower your death benefit. But then we have to think about, well, what's the impact of that on the premium and potential MEC conditions. So I'm not sure what you mean by revise to minimize death benefit and max out what we can take out. So if I understood the goal more, then maybe we can come up with a better answer.
Yeah, that's what I was getting at too. It sounds like some of your goals might have changed. You might have, maybe originally designed it for more, of a long-term strategy. And then now there's an investment you need a little more cash value for, something along those lines. But what I would recommend, I don't know if you've worked, Hannah seems pretty familiar with you guys. So I'm going to guess that maybe you worked with her before. I would just try to reach out to her, and she would be the best one to kind of walk through, well, what are your goals now? And, if there's anything she can do on the existing one or a future policy, but definitely reach out to your agent. Okay. Facebook user, sorry, we can't see your name, but when does it make sense to have a direct recognition policy? So this kind of goes back to the other one we were talking about.
And Craig, I mean, and I've heard this, so I actually have the same question to a degree, right? Some depends on location, depends on what you're looking to solve and what your goals are. But I know Nelson Nash really, I mean, I think he worked for a direct recognition company for years and years, right? From my understanding. I don't know if I want to make sure that's accurate. And used it for, I mean, set up infinite banking policies with a direct recognition company. So it still solves the banking function. It's just a dependent.
For anyone who's new on here, do you want to just kind of go over real quick the difference between, non-direct and direct? Just a brief overview.
Craig, use your $1 million bill.
Yeah, I guess the way I look at it is I kind of look at them as savings accounts. So if I have a direct recognition, I have $100 in the savings account, I take it out, I'm not earning interest. If I have non-direct recognition, my $100 stays in the savings account, earns interest while I'm still using it. So it's just how direct recognition and non-direct recognition is how the insurance company recognizes you taking money out. So when does it make
dividend
sense?
Payments.
Dividend payments. So
I'm reading something that says direct recognition is one that recognizes, like you said, and pays dividends on cash value of the policy on its actual performance, while indirect recognition companies uses a formula to calculate the dividend rate based on the overall performance of the company's whole life insurance policies.
Yeah, Craig, do you know that if you have a direct recognition, like say you have $100,000 in cash value, you take $50,000 out against the money, right? You put it to work, but you pay it back before the end of your calendar year, before dividends would be paid. Would you get the full recognition of the whole $100,000 since you put it back before the date? That's a question I've been wondering for a while.
I don't know the answer to that, but I know with direct recognition companies, they have different interest crediting strategies. So there are holy wars that sometimes come out about non-direct and direct recognition that, some people say there's really no difference at the end of the day. And because the direct recognition companies typically have a different interest crediting strategy, and sometimes the loan rates are different. But the way I look at it, if it's my preference, I would rather have non-direct. The reason there may be some direct recognition is, maybe you live in New York and you need a guardian policy or a pen policy. But here's one of the things you can do, depending on the rates in the marketplace right now, is you can go get a cash value line of credit. So even if you have direct recognition, you can get a cash value line of credit. That doesn't impact the policy when you go take the line of credit from the bank. So, and I know Chris and Sean, I don't know if you have that link, but I know Chris was looking at another bank that had a cash value line of credit that was actually pretty reasonable. So there's a lot of different options. So I don't know that I would go out and specifically seek direct recognition, but sometimes that's just what you have to deal with.
And there are options, like you said. Like I forgot, like that's a brilliant point you just brought up. You can go get a cash line of credit from the bank, but then you're most likely you're stuck back with a structured loan versus unstructured, and not being right. So there's going to be drawbacks from potentially doing that, but you might get it. Like for Chris, he loves it because it's a one pot system for all of his policies, right? So it simplifies how he cash flows. So it's going to be, again, back to your personal preference. Like how are you going to use the money? How do you cash flow? How do you make your money and keep the money moving, right? And that's what we teach. How do you keep your money moving?
Exactly. Eve, her future planning. If you have a nonprofit policy that can't MEC, can you stuff as much as you want into the policy and still make the same amount, or is a second policy needed? So this is like one of those yes and no questions. So yes, you can up until the death benefit. So that, obviously the policy you can't be insured for, an indefinite amount of death benefit on your policy. And if you keep putting more and more premium, that's going to raise and raise and raise the death benefit up until a point where, you don't qualify for, let's say your limit is 10 million. And now you're putting so much in where it's going to push it to 12 million. So now they say, okay, you can't put any more in this policy. You're done because your death benefit on this policy is limited to X amount. So
you've reached your human life potential.
Exactly. Yeah. Until at some point you can have that reassessed if you've increased your income in some way or shape or form, or otherwise increase that death benefit limit on you. Then you can, stuff more into the policy. But so it's a yes and no question depending on how much you can stuff into that policy.
I love that answer. I learned something every time here, guys. I don't know about all of you, but I usually walk away with quite a bit of notes and something new I can share. And thank you for that, Gabby. I did not know that. I did not know that. And then at the end of the day, it does come back. It is life insurance, and it is going to be dependent on the actuarial folks who, you've heard Chris talk about trying to talk to an actuary and saying, ooh, that was a bad idea. No wonder they were sitting alone. They're just a different breed, and they have all these formulas and tables and different things. But it is going to be based on how old you are, your health, your sex, and there's all these things that's going to cap out how much insurance before you have to go find another insurable interest to open a policy on. Like I helped a woman today who came back having a lot of windfalls, but she's like, I want to open one on my 25-year-old daughter, one on my 23-year-old son. And she had this idea of how much she wanted to put in. But I was like, okay, well, do they both work? Yes. Well, how much do they earn? Okay. Well, then they can put in this much per year, potentially based on their gross earnings. And then you could stuff it a little bit more and you could overfund that a little bit. But it's still, that's going to have the drawback potentially of over-insuring their body at some point. Like you can't put in.
And then to that point, Eve's point, does she need a second policy? You wouldn't be able to get a second policy on that same individual anyway if you maxed out the death benefit on your first. So if you did max that out, you could just go to a different person, within that nonprofit. If it's another nonprofit policy, then, just repeat the same process. So, it just kind of depends on what you're using it for and how much you actually have stuffed into that policy. I won't spend too much time on these ones because we did answer them, but you and he's again talking about indirect. I just kind of wanted to point out again what Jason was talking about getting back to like the reason why we're doing this is not to get all into the inner workings. Like we always say, you get in your car, you don't know how it works, you just hope it gets from point A to point B. You know what I mean? So we're kind of doing the same thing here. You have that faith in the system. So if you know enough about it to just be dangerous, I think Craig used that analogy before. Know enough about it to be dangerous, and then but don't focus on the stuff that the minor details that don't really matter too much. You're going to have a team. If you work with our team, we help you get in that direction. And as you go, you're not going to know everything about that policy, but as you go, you're going to learn a little bit more. You're going to say, okay, I'm going to try to change my oil today. I need a new wiper blade. I'm going to put a new wiper blade on. So that's kind of the effect that it will have on you as time goes on. And you need to know these things, you will know these things. But yeah, so I don't think it's too often that all of us sell, indirect, not non-direct policies. Most of the time, I'm sorry, I got it backwards. It's not often that we sell direct policies. We often mostly sell non-direct. And that's because for most people that just fits their needs. But the team has been saying, there are times and instances where direct recognition might make sense. So just keep that in mind. It's not for everybody. It's not like we push it, but it can make sense.
It's like science class all over again. AP Science. The answer is always it's surface area. Right now the answer is it depends. It's a case use basis. So it's always going to depend.
Antonio says, the rep that I've built my 2 policies with is not getting back to me for my 3rd policy. Who can I reach out to?
I wanted to look them up, but then, my computer freezes even if I have everything closed. So I could help anybody with that. I've been looking at that question for a while, thinking that's weird. So.
Yeah, that is. I think I might have seen. Well, so Antonio, I put my email in the chat earlier. You can email me. If it is Chris, it's probably my fault because I don't let him talk to anyone anymore these days. So reach out to me and I'll get you hooked up with somebody else who can help. Okay. Okay. Kind of whip through the rest of these if you guys are on board. Oh, just at least 2 more. Adam says, if I were to lend
2 more is perfect. Let's do it.
2 more. Adam and Rosewood. If I were to lend in PMC from my policy, would the interest made be taxable?
Yes.
Maybe.
Any gains from PMC are taxable. Now you could put your gains before they're taxed into a policy. Some people do it that way and then pay your taxes out of your policy. But you still do need to pay taxes on any gains.
Gabby Esquire. Thank you. Last question.
Last one. Rosewood says, so what if I borrowed against my policy and had a payment plan so that it would be 36 months in order to make my new payment low? If I wanted to, could I make a balloon payment at any time to pay it off?
Heck yeah.
Yes.
Absolutely.
Easy.
You're in control. You are in control.
You got 40 yeses.
I just did that, by the way, because all the bank
yeses.
crap going on, I had policy loans out, and I was like, you know what? I have all my tax savings in my bank, and I don't want that to just disappear. So I moved it all over to my bank policy in one fell swoop and paid the whole loan off. So, yeah. So yeah, absolutely. Okay.
Wow, we did it. And that was a lot of questions. I'm pretty proud of this team.
I know. You've done good, guys. Well, any last comments? Anybody, if anybody's out in San Diego, does want to go surfing with Chris, or at least keep an eye on him while he surfs with Joe. Joe's going to be there too. Joe Kovacevic, he's going to have a drink in his hand, probably sitting on the beach. So let us know.
Got an umbrella in it, I bet. An umbrella in his drink.
Adrian got one really good question in. I don't know if we want to hit on that real quick. Is just loan payments versus premium payments.
Oh, this is a good one.
This is a good one. And hi, Adrian. Glad you're here. So your $1,000 monthly premium deposit is the money that it's like waiting for that paycheck to come in. Like, ooh, I got it. Like I got my money in the bank, right? Versus if you're putting that money to work and you're repaying it, you're filling that bucket back up. So we were talking about buckets before. It's like in your cash value bucket, if you take out $1,000 loan and you pay back 500, well, then you can use that 500 again, right? Or make it a bigger number, make it 5,000, you pay back 2,500. You can take that money out and use it again if you have something you need, but you're filling back up that initial bucket that you took the money out of. So they're separate. Like,
yeah. It's kind of like a mortgage payment. Like you pay that mortgage, $1,000 mortgage every month, and then you have access to more of it, in your home equity. But there are two different things. Just like, your mortgage payment would be different than your home equity line payment. They'd be two different things. So you'd still have your $1,000 monthly premium. And then when you take a loan, you'd have an additional repayment.
And that additional $1,000. So if you're in that $10,000 or $5,000 bucket and you put 1,000, all of a sudden you have, $6,000 or $11,000 growing, and then you're refilling that bucket so you can use it again. Because the object is to get that money in motion. So if you're not using it, like Carson said earlier, well, then it's okay to leave it sitting in there until you need to use it. Yeah. But once you're using it and it's cash flowing, then what's to say that when you put half the money back in, if another opportunity comes up that you can make money on that money, use it again. I mean, that's how the banks make 400 to 1,300% on every dollar, is because they're doing it multiple times. Chris talks about doing that. I've heard Brent talk about doing that. Now, who's going to be the first, the second, the third person to make their money work in 4 places, 5 places, 6 places? Like, how often can you move that money to make more money?
I love it.
That's my challenge to all of you. Move your money.
Yeah, essentially all of you who's started a policy or wants to start a policy, you're kind of in the let's stop the bleeding mode, but let's patch you up and let's get to work. You know what I mean? So there's definitely light on the other side. You're making a good choice, and there's so many workshops and things that we do that kind of help you get to that next level. Like if you don't know what to do with it, no big deal. A lot of other people don't either. That's why they learn.
Well
all
done,
right, guys. Yeah,
awesome,
that was great.
guys.
If there are any questions we didn't get to, there's the pre-submitted sheet, or you can just come to next week. We'll be here again live, same time, same place, happy hour. But yeah, thanks for everybody for being here, and we'll see you next week.
All right.
Cool.
See y'all.